Well, welcome everybody and good morning. Thank you for joining us today for our first quarter market and economic update. I'm Ryan Boucher and I am joined alongside my esteemed colleague, Paolo LaPietra, as well as behind the scenes, we have Sam Macy helping us along with today's presentation. So why don't we jump right into it? We have a lot of good information to get moving with. And, much like the market overview we sent out last week, this first quarter was really about the resiliency we saw, right? Coming off of 2022, number of the headwinds that we're facing, the market was quite resilient to start this year. And so we'll talk a little bit about just giving an overview, how the markets did and, how we're invested right now. We'll talk a little bit about Silicon Valley Bank, the impact that their collapse had, and really what that meant with the Fed and overall market over the last 3 to 4 weeks. We'll talk a little bit about just the overall, high-level economic outlook, and we'll wrap up just talking about kind of the path forward from here and how we're viewing the economy, the market, how they'll all be working together, and really our views as to, how we're viewing the portfolios and any sort of moves and allocations that we will be making. So to kick off, love these cartoons. Part of the theme in the write-up that we had sent out last week is let's not fight the Fed. Now, there's a lot of nuances within the markets right now, both in the fixed income market, the equity market, sectors, different areas of the market, but a general theme right now is not fighting the Fed. And you have the piggy bank saying you saved the day, but what about next week? And it truly is. We're always kind of watching what the Fed is going to do next. We're hanging on every word that Jerome Powell is saying. And they are having, much like last year, having a big impact to start this year and really in kind of how we're looking at what's ahead of us. And we'll talk about that later as well. So when you look at just the major indices, let's talk about the S&P, the NASDAQ, the Dow, and the Bloomberg. We're using the U.S. Aggregate Index, which is just an overview of the U.S. fixed income market. But, we've seen quite the reversal from 2022, not only just with the markets in general, but along with the areas of the market that are showing strengths versus maybe not holding up as well as the general market versus last year. But we've had the NASDAQ, which is, again, a lot of those growth technology companies up almost 20% to start the year. Major bounce back from some of the volatility we saw last year with it. The S&P level up about 7% to close out the first quarter. We're seeing some lag in the Dow, which makes up more value companies. And again, if you remember to last year, that was quite the opposite. Not that the Dow was up, but it was down a lot less than some other areas of the market, a lot less than the S&P and a lot less than the NASDAQ. So we've kind of seen that flip so far in the first quarter. We'll talk about it. Not sure that's going to be the trend for the rest of the year. It's kind of been a big reversal and maybe a little overblown so far, but certainly want to mention and continue to watch. And then, the bond market has bounced back as rates have come down a little bit to start this year. We're seeing the bond market showing some strength versus, especially last year, the down market we saw in bonds. So to recap a little bit of how we're positioned right now, not a lot of major changes, a lot of, similar to where we were at the end of last year, but we continue to be overweight U.S. equities. We still have an overweight to technology, which has really helped the portfolios to start the year. We added dividend growers. Doesn't mean they're high yielding companies per se, but companies that have had the ability to grow their dividends, generally good cash flow, high quality companies, as well as profitability. We've added a profitability ETF to the mix, and we'll talk a little bit about why that's important in this environment later on in the presentation. Underweight, we continue to be underweight international equities, high yield debt. Again, we'll talk about that, the risk premium versus where risk-free rates are with the Treasury and bond yields. We had lowered our financial exposure a little bit last year, not knowing that anything like Silicon Valley Bank was happening, but just a move that we did make. And one I wanted to point out is real estate. That's an area that we really haven't dove into, mainly being the concerns over the commercial real estate market, given kind of this prolonged COVID sort of change in work behavior. So with that, why don't we go to our first section? I'm going to turn it over to Paulo to kind of go through a little bit of Silicon Valley Bank and what the Fed's doing these days.
Thanks, Ryan. So we're going to kick off with another great cartoon. This is another great one. We're looking at Jay Powell talking to the average businessman and saying that, hey, we have a process, right? And that's raising rates. But I never said it was a good process. And I'm sure a lot of us can relate to that with how quickly and how reactionary the Fed has been with their interest rate policy in 2022 and even going into this year. So I think that's a good starting point for what the next few slides are going to be about SVB Bank and where we're seeing what the Fed is going to do. So I'm sure we all know the old adage, the Fed hikes rates until they break something, but I'm still going to go out on a limb here and say no one predicted the 16th largest bank in the United States was going to go under. And while the Fed raising rates wasn't the sole reason SVB went under, it was certainly the start of the snowball effect. And in short, the pace and the height of interest rates caused SVB Bank's reserves to lose a lot of money due to poor risk management by SVB. And while at the same time, clients were withdrawing their money at a very rapid pace. On top of this, SVB clients were mostly tech companies and med startups and venture capitalists, all industries that were severely impacted by higher interest rates and slowing growth. It was a perfect storm situation. The Fed did quickly take steps to ensure confidence remained steady in the U.S. banking system by implementing the Bank Term Funding Program, which ensured U.S. depositors above that $250,000 FDIC insurance. And while this established confidence in the banking sector, it drastically changed the market's views on where interest rates are going from here. So before SVB Bank went under on March 10th, we could see the market expected interest rates to increase for the next 12 months before tailing off. And this is highlighted in gray on the chart. Now, after SVB collapsed, we could see that market expectations drastically changed, with rates starting to cut in the second half of the year, and that was highlighted in the red dotted line and the blue line here. Now, while the market is pricing in rate cuts this year, the Fed remains unified on keeping rates steady for the remainder of the year. As we know, with the Fed so far in the battle against inflation, they have been reactive, not proactive on their interest rate policy. They were late to the game with raising rates in 2022, so they find themselves on their heels on the battle against inflation. And while SVB was a major event that certainly justifies rate cuts at the second half of this year, the Fed is put in another reactive situation, choosing to communicate rates higher for longer to ensure that they can continue to win their battle against inflation. Now, we could see here, the Fed is communicating those higher rates, and that's highlighted in the blue line, keeping rates above 5% for the remainder of 2023. So what does that mean for bonds? Well, as we know, with uncertainty in markets comes volatility, and that's exactly what we're seeing here. This chart is looking at treasury yields for 1 year, 2 year, 5 year, 10 year, and 30-year treasuries. And we could see yields steadily rising throughout January, February, and March as jobs data remained strong and wage inflation remained relatively sticky, all signs pointing to the Fed keeping rates higher for longer. Once SVB Bank went under on March 10th, we could see yields plummet as the market was fully pricing in a Fed pivot, bringing interest rates lower. Since then, we could see the volatility in yields as the market expectations battle with the Fed's guidance. Now, this morning's CPI report coming in at 5%, below the 5.2% estimate, we're seeing yields continue to go lower as the market stays confident that the Fed is going to pivot. Now, The other element of the Fed raising rates and the collapse of SVB Bank is the effects on credit tightening. Now, credit tightening simply means banks slow their pace of lending and make their lending more difficult for businesses and people to borrow. This slows the economy and inflation as companies cannot borrow and invest and people cannot borrow and buy goods and services. As we could see from this chart here, while credit tightening was certainly happening before SVB Bank, starting in 2022, on the right side of the graph, there is some concern that SVB collapse will cause other banks to continue to tighten their lending standards. And as we could see here in years past, when lending standards get too tight, a recession traditionally follows, and that's highlighted here in gray. So as a recap, SVB Bank was the first victim of the Fed's hike until they break something. And while this was an isolated event, and unlike many other regional banks, this could cause further tightening in credit lending, which could, slow down the economy. We saw how the Fed has been reactive and will continue to be reactive on their interest rate policies, and this could continue to create volatility in the bond market. And while the Fed has done its job on establishing confidence in the banking sector, the market just isn't sold on where the Fed will go next, especially with this morning's CPI report. Is the Fed going to pivot in the second half of the year, or is the strong labor market, economy, and high inflation going to keep rates higher for longer? So the next few slides, I'll be giving an economic overview. And where I want to start is with labor markets. So the labor markets continue to be a strength for the US economy, with a current unemployment rate at 3.5%, which is the lowest it's been in 50 years. And while a near fully employed US is a great sign for the economy, it's also a driver towards inflation. If we look at the first slide to the left, we could see unemployment rate in blue and job openings in red. And with so many job openings that employers are unable to fill, employers are put in a position to push wages up to entice new workers, which pushes wage growth up as well. And if we look to the graph on the right, we could see the direct effect of this as wage growth drastically increased starting in 2022. Fed Chair Jay Powell has been very clear that bringing up unemployment will be a necessary component in combating inflation, and we may be starting to see the signs of this. Looking back to the chart on the left, we could see the correlation between when job openings peak, the unemployment rate begins to trend higher. And this correlation pushes over to wage growth. As unemployment trends upwards, we could see the wage growth begin to turn over, and we could see that on the graph to the right. So taking a look here at the US consumers, this is important as consumer spending makes up such a large part of the US GDP. We could see the US consumer is still in very good financial health. Taking a look at the US consumer balance sheet, we could see assets drastically outweighing liabilities, with almost 30% of assets being contributed to housing, which I'll be addressing in the next slide. With inflation being such a headwind, let's stay here, with inflation being such a headwind for the consumer over the past 2 years, it's important to look at debt to income ratios. If we look at the top right of this chart, we could see the percentage of debt payments of disposable income for consumers. And what we see here is the percentage is at a 40-year low, which is a positive sign. But the trend upwards shows that inflation is having an effect. Putting this into context to where the ratio was before the Great Recession, which is highlighted in the blue Q4 of 2007 at 13.2%, the 9.8% from Q1 of this year is very, very healthy. So the graph on the bottom right is looking at delinquencies on auto loans and credit cards for the US consumer, which is important as we discussed the credit tightening of banks from earlier in the presentation. Again, we see delinquencies in a very healthy spot compared to the last 20 years, but still that slight uptrend is something that we want to be monitoring going forward. So with the rapid increase in interest rates, the housing market has had growing concern that we could be headed towards another housing crisis. And from the last slide, this is important with homes making up 30% of the US consumers' assets. The largest differentiating factor between the '08 housing crisis and now is the housing supply. And if we look to the top left of this graph, we could see the supply of new and existing single-family homes for sale at a 40-year low and drastically lower than the peak, which was in 2006 to 2009. Now, on top of that, if we look to the right, we could see housing builds have also slowed, dropping below the 60-year average. So to put this simply, the lack of supplies of homes combined with the continued demand will continue to hold homes values going forward and lead to a healthy growth in the sector. Now, of course, we couldn't have a market update webinar without discussing inflation and where it's going. So here we're looking at an inflation heat map. And while we have a lot of numbers here to look at, it's quite simple. Red means prices are increasing and green means prices are cooling. And if we look at the top of the chart, we could see headline CPI peaked in June of 2022 and has been consistently coming down since. This morning's CPI report supports this with the headline CPI coming in at 5%, again, which is below that estimate of 5.2%. And while this is great news in the fight against inflation, we still have ways to go to get to that Fed's 2% target. And where we're seeing the stickiest inflation is in core services, specifically homes, which we could see on the bottom right of this chart. This ties into the previous slide that home prices will most likely continue to remain sticky simply due to the fact of lack of supply. And continued progress in CPI trending towards 2% is going to be a pivotal driver on the Fed's decision on where to take interest rates going forward. Now, taking a look at consumer sentiment, we could see how the consumer is feeling on the overall markets. And likely to no surprise, if we look at the bottom right of the graph, we could see the consumer sentiment is low, which could be contributed to inflation, market volatility that we faced last year, and geopolitical risks, most specifically Russia and invasion on Ukraine. And what's interesting about this data point is that when consumer sentiment bottoms out, which as of now looks like that could be the case for Q4 of 2022, the S&P 500 averages a 25% return for the next 12 months. And while this isn't an end-all be-all sign for market returns for the remainder of the year, it does provide convincing data that the markets are extremely efficient and forward-looking. So when confidence in the markets seem to be at all-time lows, these are historically some of the most opportunistic times to invest. Here we're looking at leading economic indicators, which are used for a tool to predict potential recessions on the horizon. And LEI looks at a slew of different factors such as manufacturing, consumer expectations, yield spreads, and unemployment. That full list of all the LEI factors are on the right-hand side of this graph. And again, like consumer sentiment, while it's not an end-all be-all, there has been a strong historical correlation between sharp drops in LEI and recessions. And we could see the effect of rising rates has had on manufacturing and consumer expectations specifically. And while a recession could be on the horizon, not every recession means the same for the economy and the markets. As I mentioned before, the markets are very efficient and most importantly, forward-looking. So the market volatility we faced last year from the fears of how much the economy would slow down from the Fed's interest rate hikes may be factored in. So again, it's not to say that we're safe out of the woods yet, but more to show that a recession is a possibility and may have been priced into the markets as of last year. So as a recap, we saw the US consumer is still in a good shape. but inflation is showing its effects, as we saw an increase in debt percentages of households starting to uptick, but still, again, well below those historical averages. The housing market remains stable due to lack of supply of new and existing homes, which again is important as it makes up 30% of the consumer's balance sheet. The fight against inflation is continuing to make progress, with this morning's headline CPI report coming in at 5%, but we still have ways to go to get to that Fed's target of 2%. Consumer sentiment is low, but as we saw, this could be an indication for strong market returns, as we saw from historical averages. And finally, a recession may come, as we saw from those LEI indicators, but not all recessions mean the same for markets. So without further, I will pass it off to Ryan.
Great. Thank you, Paulo. And so let's bring it all together, right? What's going on with the Fed, what's going on with the economy, kind of taking a look at what the markets have been doing and try to paint a picture of what we see ahead for us. So we go to the next slide. We have, it does feel like, especially since the Silicon Valley Bank news, just feels like there's been more and more negative headlines out there. And you're seeing, here we have the bull, you mean bad news is bad, and you get a bear saying, yeah, it is. And it just kind of, even anecdotally, it seems like we're seeing more market commentary that this bear market and recessions on the horizon. But let's take a look a little bit closer at some of the market data that we've been looking at now and over the course of the last 3 to 6 months. So this is a chart. I used this in our market update that went out last week. It's really just meant to show that the gray bars are from December 31st last year. The blue bars are from today. And essentially in every sector, earnings expectations have come down. You can see, by what percent in each one. But the expectations, it's not like all of a sudden, we had this rosy picture of the economy. I mean, market expectations for earnings have been coming down. And this is something that the market has reflected in the volatility that we saw, especially over the last year or so. And we look here, again, just quarterly path of consensus S&P earnings per share growth. And again, we're seeing a dramatic downgrade for first quarter of this year, a downgrade for the second quarter of this year. It's not like the expectations we're in this major growth environment. Most of the expectations, even before Silicon Valley Bank, have been quite negative. And frankly, last year we saw, outside of the energy sector, we actually saw an earnings recession within the stock market. Most of the S&P 500 companies and sectors actually saw earnings slow down last year, but we had such a big, large boost in the energy sector, given where the price of oil did, that it really kind of buoyed most of the market. But we talked, especially the second half of last year, we were in an earnings recession, and frankly, it's going to be hard to know. We may have already started or been in a actual economic recession as well. We talked about our addition to profitability, and this is a little bit about talking about strong quality companies as well as trends in earnings in corporate America. We're seeing on the chart on the left, we're seeing S&P profit margins start to decline. Over not only the last couple of years coming out of COVID, but even before that blip from COVID, we're seeing really strong profit margin growth. A lot of that was driven by technology companies being able to do more with less, and some of the software innovations that we were seeing. But right now, in heading into recessions, you tend to see profit margins drop. So we've talked about adding profitable companies to our portfolio. We think those, again, make up quality companies when we see market uncertainty. Some of the dividend growers we've talked about, again, they're companies that have grown dividends in previous bear markets and in recessions. Again, we feel that those are companies that can withstand uncertain cash flow, and they have strong balance sheets, a lot on their assets, strong assets. So we like those types of companies. I circled healthcare and consumer staples because we do have direct ownership in those types of sectors within the portfolio. And, so far year to date, they actually haven't been the strongest. But in this economic uncertain time frame, we're very comfortable. You can see they have the narrowest range of profit margins in those sectors. They have a little bit more price stability, a little bit more control over their costs and their pricing. So we feel, again, in these economic uncertain times that we could be seeing ahead of us, those are good areas of the market to be allocated to, on top of those dividend growers, as well as those profitable companies that we've added to the portfolio. What are some different areas of the market telling us, right? We've seen a lot of the headlines about the fear of a recession. I won't get too much into this chart in terms of all the ins and outs of every piece of data point, but what this is showing us is both U.S. investment grade bonds, which is the black line, as well as high yield bonds, which is the red line. And essentially what it's showing us is the risk premium of these different asset classes over a risk-free asset like a U.S. Treasury note. And, oftentimes what you see heading into a recession is a very sharp spike, especially in high yield, that red chart or that red line, high yield bonds, because you're required, if you want to earn, more yield from riskier assets in the bond market, you got to pay a premium for that. There has to be something, there has to be a risk reward element. And we're not seeing that on the rise like we have in previous recessions. So as uncertain and as uncomfortable as it feels in terms of the headlines that we are heading to this inevitable recession, the fixed income market is a very, very sophisticated market and very good sign of things to come. And so far, we did see a little bit of a spike following Silicon Valley Bank collapse, but we're not seeing the type of spike that you typically would see as you enter to a recession. Again, this doesn't tell us everything, but it's just an element that we're taking into account of, hey, what are these sophisticated markets telling us, outside of just what the headlines are telling us? And when we talk about fixed income and bonds, we started adding more to the fixed income market at the end of last year, moving away from some of the alternatives that we held. We still hold some of these alternatives, and we'll be probably moving some more into fixed income in the coming weeks or months. But what I think it's really important, this just shows you the correlation of the 5-year total return versus the starting yield to maturity of the Bloomberg US Aggregate Bond Index. And whether you're holding individual bonds or bond funds, these returns are very, very correlated, meaning where today's rates are for the US aggregate bond market, you can almost expect over the next 5 years that that's what's going to be your return on these bonds. So right now it's at a little bit more than 4, just under 4.5%. Again, not a bad entry point into the fixed income market. We've done that, and we will probably continue to enter the market as we see some stabilization following what we saw with Silicon Valley Bank last month. In talking about, okay, if we do see kind of the slowing economy, we already saw in Paulo talked about the low inflation number from today. If we continue to see a slowing economy, that would probably cause a Fed pivot sooner than later, especially. What we've seen historically over the last 45, 50 years, the last 6 times that happened, outside of the tech bubble of 2000, the next year, the market had rallied pretty strongly over that time. And so that's what this chart is showing. The gray line, again, is the tech bubble. That's kind of the exception to the rule. Without getting too far into it, though, we're in a much different place than we were at the tech bubble, from valuation, from just a market exuberance perspective. I don't think we're feeling the exuberance in the markets, at least from my conversations with many clients and folks in the industry. So much different time than 2000. And similarly, what does the Fed pivot look like for bonds? Well, if the Fed were to pivot and have rates come down, well, that's typically good for the market value of bonds. And so you can see, again, over those last 6 times, we've seen the bond market continue to rise. So again, it's a good time to be diversified, good time to have allocation of both equities and fixed income. And again, if we see that slowing of the economy, probably will mean a pivot sooner than later. This just goes, past 70 plus years of 60-40 portfolios, not saying that the 60-40 portfolio is the right allocation for every one of you out there, but we did talk about it at our State of the Economy back in January, and just want to reiterate, when you look at all the way to the right, year to date, that blended portfolio up about 6%. We've talked about the strength and potential strength of stock market, of the fixed income market. We continue to feel that having that diversification, as bad of a year as we saw last year, will benefit clients and investors, now and into the future, especially. And just to kind of bring it all together, we are seeing uncertainty and headwinds, right? I mean, there are, especially in the banking sector, credit markets, there are signs that the economy is slowing. But again, this isn't happening overnight. This has been a trend since the end of last year. We've seen this, and the market has taken that into account. When you look at the 2022 stock market returns, I think we're reflective of a slowing economy. Even though the headlines were all about the Fed and interest rates and where rates were going, higher rates, again, the effect of that is a slowing economy. The market and the economy don't always line up. The market's always thinking ahead. I truly believe in a slowing economy, if we're seeing it or if we're in the middle of it, that a lot of that has been taken into account. Doesn't mean we're not going to get volatility ahead, but if it's not a deep recession, if there's not a catalyst to drive us lower, I think a lot of a potential slowdown in our market, in our economy, has been taken into account with last year's market sell-off. And we talk about the path forward, talk a little bit about this in the market write-up as well, but strong, stable economy, rates may be higher longer, but valuations are supported. Where the market is today are supported by those earnings growth and where we're at in the market cycle. If we see a weakening economy, maybe some slowing of earnings, a mild recession, we will probably see a Fed pivot sooner than later. I would expect having some volatility in the overall market, but again, I think a Fed pivot on a forward-looking basis, intermediate to long term, is going to be supportive of stocks and could be a good thing for stocks. And lastly, I mean, there's always that chance of something of the unknown, right? We talk about it with COVID. There's always that possibility that something's out there we're not expecting that could really drive the markets lower. There could be unknown risks out there, hard to avoid. What's key is, are you in the right allocation? Have you done proper financial planning to get comfortable with volatility in the market like that? And if you have something in the next 2 years, 3 years that, big, spending need, are you protected on that? Are you taking distributions, making sure that you're properly allocated to take into account anything on a shorter term basis? But, when we look out again over intermediate to long-term perspective in the market right now, we continue to have that cautious optimism as we're looking at what's ahead. Again, it doesn't mean we're in the clear. Certainly the potential for added volatility up and down because there's still so many unknowns. But all things considered, we remain cautiously optimistic right now. And with that, thank you so much for joining us today. I know we went through a lot there. We'll send out a link for the video replay. We'll try to send out maybe the market update as well, so you can read that if you haven't already. And if you have any questions, if anything comes to mind, if you want to review any of these slides that Paulo and myself have discussed, please feel free to just reach out to us. Give us a call, send us an email. Happy to discuss this in more detail. So again, thank you so much for joining us today. Hope you have a great rest of your day.